also create future mode with innovation. There are many different ways to analyze innovation. It could be qualitative, it could be quantitative. For qualitative, we look for innovations in 5 areas that I've mentioned before during the presentation. Not only products and services, but the way they manage supply chain, marketing, customer relationship, how they organize themselves as well. For quantitative, we look for companies that are spending a lot on R&D, but we also look for companies that are generating revenue from new products as well. And we also look at profit margin of those new products to make sure that their R&D spend is actually generating higher ROIC. And quality. This is where we look for sustainability of all the positive attributes that we have identified. And lastly, the valuation. We do care a lot about valuation. Given the cyclicality of the emerging markets in Asia, we try to be very patient and buy companies at the right price. Those are the 5 basic framework how we pick bottom-up stocks in Asia.
Okay. Berkin, could you tell us what percentage of a portfolio under normal circumstances for a normal average risk tolerance person should be in bonds in your estimation, and how much should that be in today's market?
So I think that has a lot to do with the age of the person, right? I think generally bonds are used for downside protection and income, right, which they're actually delivering for the first time in a while, as we discussed. So in today's market, I think a 60-40 actually makes sense from a longer term point of view. If you're thinking of things a little bit more, I can shift things around quicker, I'm 70-30. I just feel like stock markets are in for some trouble here potentially. That's why I reduced my personal stock market exposure. And as I said, I can actually earn a lot on the bond side, which helped drive that decision to say, let me just take some chips off the table. It's been a good run for 20 years. Stock markets have gone up a lot. Let me reduce some risk and see, I may be wrong. I mean, stocks are doing fine this year, right? That's sort of the beauty of, and the challenge of investments is nothing is certain. But I think from a long-term point of view, a 60-40 portfolio makes sense again.
Okay. Why don't we open up for questions from the floor?
Yeah, I'll get started with one from back here. If anyone has any questions, feel free to write them down on the index card. First question is concerning commercial real estate, and the question is whether you're concerned that a crash may spread to the rest of the financial services industry, specifically regarding commercial real estate.
Yeah, so there is a lot of concern. There's a lot to be concerned about commercial real estate. I will tell you a couple of things. First of all, everything in commercial real estate takes years to play out. So if you're expecting like things to fall apart in 6 months, and that's not going to happen. The issues with commercial real estate are going to take a long time to play out. The biggest problem is office buildings, right? We've had other issues in the past. We had shopping malls because Amazon came around. Then we had COVID. Nobody was going to hotels. Offices, that became a real problem because there was a lasting change. People are not coming to the office. I mean, like half of the people are coming to the office, maybe. So these leases are long-term. When those long-term leases start running out, these commercial real estate properties are going to be in trouble. The people who own the commercial real estate, the equity, that's going to be the first in line. But in many cases, the people who lend against commercial real estate are also going to take losses, right? And those are generally speaking regional banks. That's why this is stoking some of the fears that you're seeing out there. And banks with a lot of commercial real estate exposure are kind of being singled out. And that's where you're seeing a lot of like the publicly traded ones, their stocks are having a lot of challenges. This issue is real. It's not like a one-off thing, and it's going to take a long time to play out. And I talked about mortgage-backed securities. I was talking about residential mortgage-backed securities. Our firm has invested in CMBS and commercial mortgages a lot. we don't have pretty much any exposure to that right now because of these concerns. The only thing we like in commercial mortgages are multifamily homes because it kind of ties into residential. People need places to live. But the office situation is definitely going to be challenging. Right? And it's going to take many, many years for that to play out.
Thanks. Michael, next over to you. And the question is, what country in Asia is currently most attractive?
I think a lot of people, when they think of Asia, they think of China. But if you look at Innovator's portfolio, China is still very important. It's still 35% of the portfolio, but there's another 65% that are as attractive as China looks today. If I look at the valuation only, I think China is probably the most attractive looking country at the moment. As I mentioned, I've never seen a valuation, especially when it comes to tech companies, being this cheap in the past 20 years. Apart from China, I think India is also looking very attractive demographic-wise. India is still a very young country. They're about 10, 15 years behind China when it comes to everything else, when it comes to infrastructure building, when it comes to internet services. India is attractive. Vietnam is also another country that are looking very attractive. Vietnam reminds me a lot of how China or Korea used to be 10, 15 years ago. And Vietnam, I think, is looking very attractive over the past 10, 20 years to come.
Thanks, Michael. One carry on to that question is, you talk a little bit about China's future and growth over time.
I think it's very important to be engaged with China. I think it's very easy to hate China right now, given all the political tensions. But there's still 1 billion plus people in China. And I wanted to remind our clients that we don't invest in China, the country. We invest in individual companies. And we buy companies that are serving the Chinese consumers in China. So I'm still quite optimistic. I think in the short term, they're still facing a lot of challenges. The consumer sentiment is really poor. I think coming out of the pandemic, I think the trauma that Chinese consumers went through during the pandemic has been much deeper than we expected. So the reopening process is happening, but it's not as strong as we expected. But we do believe that it's ongoing, but the recovery is going to be slower than expected. The property market has been another big negative for China. The property market has been very weak and it's very slow to rebound. China doesn't face the same type of issues that we have here. For example, commercial real estate is fine in China. Everyone's back to work in Asia. It's the consumer sentiment that's really driving people not to purchase anything that are very expensive, houses or big appliances. But the recovery is happening. A lot of our colleagues were on the ground. Restaurants are full. People are back traveling. So even the process has been slower than expected, but it's ongoing, and we do expect better second half versus first half.
Thanks, Michael. And then back over to you, Berkin. One of the questions here is, where do you feel interest rates are going, and then where do you think they might settle in at once they come back down?
That's sort of the million-dollar question. So we think that the Fed is going to have to cut rates soon. Usually, that would not happen when inflation is, it's like almost 5%, right? 4.5%, 5% right now. But you got to keep in mind that it came down from over 9%. So it's on the way down. Furthermore, these bank challenges that we've had are actually big problems. I mean, we had the second largest bank failure in history, the third largest bank failure in history, and the fourth largest bank failure in history happened 2 months ago, or 3 months ago. So that's a big deal. This happened because rates are high, because these banks were forced to buy very liquid, safe government bonds at 1%, 2% yields. And then when deposits started coming out, they had to sell them 20 points lower and realize massive losses, right? This is a big deal. It's not just those banks. There's plenty of banks out there that have capital challenges, liquidity challenges. And so the Fed is watching that carefully. And if these things continue, they're going to have to consider cutting rates. Now, Whether that happens late this year, early next year, I don't know. But if you think of kind of historically what's happened, the time difference between the last interest rate increase and the first interest rate cut is actually about 6 months. It's not that long, right? So that would kind of make sense. If the last hike is maybe in June or July, maybe late this year, they start cutting rates again. I think they probably cut at least a couple of points over the next few months. And so maybe we settle in a situation where the 10-year is around 2%, the front end of the market is around 2%, so at least like the curve isn't inverted like it is now, and it starts looking more like an upward sloping yield curve to try to push the economy to keep growing again as we try to work our ways out of the recession at that point.
Great. Thank you so much. I'm going to turn it back to Lou now to wrap up the program.
Okay. Let's just give these people a big round of applause. Both put their hearts and souls in what they were saying, and we brought them in because we agree as value players. Okay, I just want to, if somebody has the gifts we have for these people. Okay. Thank you very much.
We're going to wrap up with cake inside, and there will also be a survey for today's program. Thank you very much.